I didn't buy gold because I thought the gold price was going to go up. I buy gold because I'm afraid that the price of gold goes to $6,000 or $7,000 or $8,000. I bought gold as insurance.
Hi, everyone. This is Sean Ring from the Root Awakening. It is a pleasure to be here once again on Paradigm Press's new YouTube channel. Today, I have the honor and privilege of interviewing Mr. Rick Rule. I'm sure you've heard of him, but just in case you haven't, Rick was the president of U.S. Sprott Holdings for about 10 years. Now he is the head of his own family office in the Pacific Northwest. He is both an investor and a speculator and a credit analyst, which we'll get to quite quickly. Rick, thank you for joining us today. How are you?
Sean, thank you. I'm a Rude fan, so I'm delighted to be interviewed by you in particular. In
Well,
answer
thank
to the
you.
question, I'm doing very well. I failed retirement completely, which is a delight to me. And one of the lovely things about quasi-retirement is that I have more time to talk to folks like you, and I spend less time talking to regulators, which were the bane of my existence at Sprott.
Rick, you've been, as you mentioned, you've been around, I think 45 years you've been doing this, over 45 years. It's an amazing amount of time to log in. Clearly, jives with what you just say with your passion. What period of time, if there is one, from previously in your career does today most look like? I mean, is this unprecedented? Or does this look a lot like 1970s something?
I think somebody said history doesn't repeat, but it rhymes.
Rhymes. Mm-hmm.
And I think that's accurate. There's a lot of things that have changed. But if I had to pick a time uh, that this feels more like, perhaps it would be the 1970s, at least in the United States.
Mm-hmm.
Um, eh, like the 1970s, particularly because in the 1970s, we had come off of 20 pretty benign years. Since the end of World War II, uh, the United States had led the world in a fairly peaceful time from 1945, certainly through 1965.
Right.
Uh, Great credit markets, great equity markets, demographic expansion, peace, the expectation that things were only going to get better. While under the covers, things were getting worse because we had the confidence and because we tried to focus on more important things, we allowed for the inexorable rise of government. We developed this counterparty in our life that turned out to be a cancerous counterparty. In the United States, in particular, our confidence led us to attempt to fight the war in Vietnam and the war in poverty simultaneously. Uh, by the way, we lost both wars.
Yeah,
And
indeed.
trying to finance both guns and butter, we ran into a circumstance where we violated a wonderful old ditty. The ditty goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. It was very clear to anybody who paid attention, which is to say, any credit analyst, that by 1970, the fiscal course of the United States and the Western world was unsustainable. But because we'd been through 20 or 25 good years, people ignored the warning signs. They had been taught to buy the dips. They had been taught that interest rates only go lower. They had been taught that equity and real estate prices only go higher. So, despite the fact that the financial condition of the United States in particular was deteriorating fairly rapidly, confidence reigned. Now, they did deregulate the gold price. So the gold price went up fairly precipitously, not merely because of the fear of inflation, but rather because it had been price controlled for 40 years. In the middle part of that decade, I am convinced myself that the inflation lesson hadn't been learned yet. But in the middle part of that decade, the Federal Reserve, acting wisely, I believe, raised the interest rate, which collapsed the gold price.
Right.
Gold had risen from $35 an ounce to $200 an ounce. Raising the interest rate took the gold price down by half. But it also took the stock market down, and it decimated the bond market. Congress lost their nerve. continued to spend like drunken sailors while at the same time lowering the interest rate. When that happened, inflation went from the 7% range, as measured then, which is different than now, yep, to the 12 or 13% range. And what that meant was that savings accounts were paying substantially less than the rate of the deterioration of the purchasing power of the dollar. And the gold price went parabolic while the equity markets and the debt markets collapsed. In that sense, it seems to me that the decade that we're coming into resembles somewhat the decade of the 1970s. We have now come off 40 fairly benign years in the 1982 to 2022 period. I'm not trying to say there weren't some challenges, 2008, stuff like that. Mm-hmm. But we've come through a period of 40 years of declining interest rate, strong US dollar, and the strong US dollar moderated at least the impact of inflation. I think that's over.
Right.
But I don't think that the confidence has subsided, which means that I think that there's going to be a 2 or 3 year hiatus period between the reality that a hardworking credit analyst might see as an example and the reality perceived by an investor, speculator, saver, or taxpayer who has been lulled into security by 40 benign economic years. Sean, don't confuse me with the doom and gloom guy. I think the world 15 years from now is going to be much better, almost unimaginably better than it is today. But I think we have to get from here to there. And I think we need to understand the nature of the improvement. The improvement is not going to come out of Washington or Ottawa or Brussels. The improvement is going to come because, at least in the United States, we are still such an innovative society. We are still so tolerant of success, at least for a while, that 5 or 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple, which is to say that our individual creativity and tenacity is so spectacular that we have been able to and will continue to be able to afford our collective stupidity. But that assumes that each individual looks after his or her well-being. And I think that'll be the challenge for the next 10 years.
That's fascinating. May the nerds save us. And I think that's another fantastic point, because you said that there might be a 3-year kind of lull between what's going on and reality hitting us. And funnily enough, I was just arguing with one of my best buddies from business school, who's an old guy at Morgan Stanley. I'm like, we're in trouble, but not yet. Because I've tried to calm my own, oh my God, the sky's falling. What keeps you up at night? Like right now, like what is the thing that you go, oh God, when this happens, forget about it.
There's 3 things that keep me up. The hubris of the global political leadership flirting with world war. Mm-hmm. The idea that we shouldn't talk to our enemies, but rather that we should disparage them for internal political purposes. This is an insanity.
Yes.
The idea in Congress that we shouldn't talk to the Chinese, that we shouldn't talk to the Russians, that we shouldn't talk to Hamas. This is insanity on the highest order. If you have a problem with somebody that's resulting in other people dying or your people dying, you owe it to yourself to find as much common ground with the other combatant as you possibly can. The idea that we're conflating Israeli casualties with Palestinian casualties as though one side is good and one side is bad. I'm not going to get into the underlying conflict. I'm not going to do that. What I'm trying to say is that we owe it to the world to prevent casualties to the extent we can. And one of the ways that we do that, no matter how odious we find certain aspects of the other side's behavior, if there is another side, we have to engage discussion. So that keeps me awake at night. I had the very, very, very good fortune to not have to fight the war in Vietnam, something that I'm eternally grateful for. That war was a war without purpose, like most wars. The second thing that keeps me up is somewhat more mundane and just somewhat more mundane. I think there's too much complacency in the world around government debt and around the reliance on other people to shape your life and to get ahead. And I think that there's too much I think there's too much complacency about the general deterioration in the purchasing power of fiat currency. Most of your readers, Sean, if you ask them about inflation, would direct you to the CPI, the Consumer Price Index, which I don't believe is a gauge of inflation. And I don't believe that most readers of yours or customers of mine have paid attention to the difference. And that bothers me. If you regard the CPI as a relevant measure of the deterioration of the purchasing power of your savings, you are underestimating that deterioration. Firstly, the CPI is a constructed index, which is to say is hedonistically adjusted. The people who put it together assign values to economic outputs.
Yes.
If an apartment today is bigger and better than an apartment 40 years ago, they hedonistically adjust it, not taking into account the fact that people need places to live. So that's one problem. It's artificial. A second problem is that when it's inconvenient for the organizers with regards to core inflation, they leave out food and fuel. Both you and I, Sean, like to eat. So that sort of index is of less use to us in terms of understanding the impact of our own cost of living. But the most idiotic aspect of the CPI is that it doesn't include tax. The cost of government is the biggest household expense for most working families in the Western world. It is larger than housing, food, energy, and transportation combined. Now, Sean, I promise you, I think, if I didn't have to pay the tax, I wouldn't bitch so much about the index. But the truth is that regarding the CPI as a measure of the deterioration of the purchasing power of your savings is a falsehood. I attempted to do a thought exercise looking at my own household budget in the period 2000 to 2003, using those old university lessons I learned, probably poorly, by the way. And I determined roughly that the purchasing power of the basket of goods and services that I combined, including frivolous expenses like my, Agora subscriptions and stuff like that, meant that the purchasing power of my savings were declining at about 7% compounded, as opposed to the 2.8 reported in the CPI. Now, what that means is very profound for me. It means that if I buy a US 10-year treasury, the world's benchmark saving instrument, they pay me 4.6% in a currency where the purchasing power is depreciating by 7%, that the value proposition offered up to me by the US government is that they will steal 2.4% of my wealth compounded for 10 years. I seldom believe in government promises, Sean, but I absolutely, positively believe that they will keep that promise, and it's not a good one.
No.
This sanguine sense that people have about the future and about utilizing statistics that are assembled by the big thinkers in the world is the second thing that keeps me up, because I suspect that you are seeing tens of millions of people that are experiencing deteriorating standards of living, looking for someone to blame. And because I'm an old, fat, bald, white, rich guy, I'm afraid they might blame me. The third thing that keeps me, and by the way, mistakenly, I'm investing very hard to provide a range of goods and services that bring people's cost of living down, not up.
Right.
The third thing that keeps me awake is I have a sense that because people are misunderstanding what will happen to them, and because they have a false sense of confidence, that the erosion of confidence won't happen gradually, but rather will happen precipitously. Specifically, I'm afraid of a credit event like the credit event that occurred in 2008. I'm not certain this will happen, but I'm afraid it'll happen. And the place that it scares me the most is in the subprime credits. Commercial mortgages on second tier real estate. Side note, I was in New York City not too long ago. I was in a second tier building, Midtown. The building was 16% occupied.
Yeah.
The building can't service the operating expenses and the property tax, let alone the mortgage. But what scares me more in the commercial sense is subprime commercial loans, which is to say junk debt. There are between $2 and $3 trillion in junk debt ETFs in the United States and Europe. Investors that are chasing yield, but they're sacrificing credit quality.
Right.
That in itself is scary enough because the people who are investing in this stuff don't know anything about credit. They're just chasing yield. But what scares me more is the sort of structure of these products. These ETFs are hugely liquid. They trade billions and billions and billions of dollars a day in $5,000, $10,000, $20,000 units. But the underlying assets that they own are completely illiquid. They are over-the-counter traded bonds very often from subpar credits. And if we hit a point in time where there is a question about credit quality, which there should be, much as there was a question about the credit quality around the real estate market in the United States in 2008, I think you'll have a circumstance, or you could have a circumstance, where people begin to sell these ETFs. When they sell the ETFs, the managers have to sell the underlying asset to redeem the cash. There was a saying when the junk bond market collapsed the last time, the Drexel-Burnham collapse.
Michael Milken,
and they described these illiquid bonds as owl bonds. Your guy from Morgan Stanley will know what that means. An owl bond is when you call your broker and say, please sell this bond. And he says, to who? To who? This circumstance where people sell the ETFs and the managers go to sell the bonds, but there's nobody to sell the bond to.
There's no bid. Yeah.
A recipe for the replication of what we experienced in 2008. The problem with that, well, that's a problem in and of itself, but a much larger problem is that the government itself has much less rope to push than they had in 2008. The on-balance sheet obligations of the U.S. government now exceed GDP, which is to say the U.S. government owes $33 trillion on balance sheet. Admittedly, only 26 trillion after the Fed's own balance sheet, which is to say after quantitative easing, or more properly, counterfeiting.
Yes.
But a bigger problem is the off-balance sheet liabilities, the net present value of entitlements, Medicare, Medicaid, Social Security, which is to say old, fat, bald guys like me. That number in the United States exceeds $120 trillion by the estimates of the Congressional Budget Office, which is to say our government is much more illiquid and much more encumbered now than in 2008. So the ability to afford fiscal stimulus is much lower. So I'm afraid of a crisis in confidence sparking a credit crisis, sponsoring a liquidity crisis without the government's ability to spend, print, and borrow our way out of it. Do I know this is going to happen? No. Do I think it's going to happen? Unfortunately, I actually do think it's going to happen. I think that there is a probability rather than a possibility that we will have a credit-inspired liquidity crunch at some point in time. We're going to get through it. Listen, Sean, a bear market doesn't destroy wealth. If the price of a house falls in half, the value of the house doesn't change, but the ownership changes.
Right.
It goes from weak, stupid hands to strong, smart hands. Now, the weak, stupid hands don't like that a bit, you know, and it's going to be up to your listeners which camp they inhabit. The weak, stupid camp or the strong smart camp. And unfortunately, more people will inhabit the stupid weak camp, and they will be very resentful.
There are just some fascinating nuggets that you put in there, and things that I'm sure most regular investors wouldn't even look at. Is there anything? Is there any kind of telltale sign? Is there something that they could kind of be on the lookout for and go, oh, I've read that in the paper. Now there's a great probability of, you know, our impending credit event.
I think the signs are already there.
Mm.
It doesn't have to happen. And by the way, this isn't going to be the end of the world, but it is going to be the end of marginal over leveraged portfolios.
Oh,
So,
incredible. Hmm.
although humankind will get through this, I hope, without wars,
Yes.
individual investors, I think the next 10 years are going to be a lot less benign than the last 40 have been. And I think that people who are looking at the world through the lens of the last 40 years need to begin to shift the lens a little bit. I don't think that people should be so defensive that they crawl in the corner and curl up in fetal position and whimper and moan.
Hmm.
I just think that people need to invest from a value perspective, and people need to get their personal balance sheets in shape because the government balance sheet is not going to get in shape. You can't trust the big thinkers. You can't send mommy to Washington and have her to kiss this and make it better. It ain't going to happen.
Yeah. And speaking of this government crazy spending, if I could kind of segue into um, nuclear and uranium, because I know you're very very hot onto that. I mean, we've seen governments, and you're sandwiched between Justin Trudeau and the mess south of the border, but I'm in the middle of Europe where Germany just keeps committing economic seppuku over and over again due to environmental reasons. What's your outlook on uranium? We've seen this fantastic rally. Do you think it's going to continue? Have governments finally
I
come to the
do.
end of the rope? Yeah. Okay.
I do think the rally continues, although I believe the easy money has been made.
Right.
Uh, the delta between a commodity and commodity stocks that are hated, like uranium was 2 years ago, and the absence of hate is the easy money. In extractive industries, in commodities, in capital intensive cyclical businesses, you buy stuff when it isn't just out of favor, but rather when it's hated. And that's gone with regards to uranium. It's ironic that 3 years ago, people like me in the uranium industry were vilified, and now Biden wants to subsidize us. No, I need to say I feel I feel a little dirty, given the fact that he is sort of rallying around me now. But it does amuse me,
Yeah.
given what has happened in 3 short years. There has been a realization, I think, on a global basis, that in terms of non-carbon generating baseload electricity, there are no other alternatives to uranium.
Mhm.
When when we talked about uranium stocks 2 years ago, the arithmetic was very simple. The uranium industry on a global basis was spending about $60 a pound fully loaded, if you include tax, cost of capital, and prior year write downs. And they were selling the stuff for $30 a pound. They were losing $30 a pound and trying to make it up on volume, being miners. Now, either the price went up to the point, $60, where the industry returned its cost of capital, or else there wasn't going to be any uranium. The lights would go out. What do you think is most likely? I mean, that was a no brainer.
Mhm.
Now the price of uranium is $75. But much more importantly, the volume in the uranium market has changed from the spot market, which is to say where there's no price certainty overnight, to the term market, where both producers and consumers can lock in prices for as long as 15 years. That means that some of the consumers don't have to worry as much about price around supply and price shocks. And it means that the producers, if they're prudent, can lock in floor volumes and understand at least what their top line number is going to be as far out as 15 years. The investors haven't recognized that yet. The easy money was made with the absence of hate. The real money now comes because there's a structure in the uranium business that is solid enough that you can increase the size of your business by 50% while locking in your margins too. As that flows through the income statements and the balance sheets of the uranium companies, and the narrative gets extended to the generalist investors will come into a space, and there is not enough market cap in the space to hold their money. That'll be the blow-off phase,
Right.
which is to say, after the solution has already been solved and after the pricing levels have risen to the prices where they don't need to go higher, the market will be invaded by the morons, and the market will go substantially higher. It has always been thus, and it will be thus again.
Fantastic. Okay, so let's go from uranium to I guess now it seems to me that they're hated. Gold miners, I mean, you can't poke them with a stick; they're not going anywhere. Gold has been bumping its head against 2,000 now for how long? What's the story with them? Are they just that hated that we should pile into them now and hope to make easy money where we missed it with the uranium?
That could be the subject of a whole interview. It's fascinating. I need to disclose, first of all, that although I make fun of gold bugs, I am one.
Yeah, sure.
And I've been in the gold business for a very long time. And about 2 or 3 years out of every 10, it makes me an absolutely unbelievable amount of money. And for 6 or 7 years out of 10, it tortures me. Having been in this market for damn near 50 years, I've come to tolerate it for what it is. I do believe that a sea change is coming in the gold price, which is not something I've believed in for a long time. I also need to tell you that I own gold now. I began buying gold about the year 2000. A financial planner would look at me and say, "You're the largest shareholder of Sprott, a brand name for precious metals. You don't need to own gold. If the gold price goes up, you're going to do stupidly well over there." But I own gold anyway because it allows me to sleep nights and stay calm. I didn't buy gold because I thought the gold price was going to go up. I had other speculations. I bought gold as insurance. I bought it as good liquidity. And when people say to me, "Well, the gold price has gone nowhere. When is the gold price going to go up?" I say, "Well, I bought gold for $255, $260 an ounce in 2000. It's almost $2,000 now. So when you ask me when the gold price is going to go up, I have to say to you, the year 2000. 20
Thanks
years
to
ago.
Gordon Brown, right?
Yeah. What do you want? I mean, you've seen what, a 7-fold, 8-fold increase in the price of gold, and somebody's asking me when it's going to go up? That's funny. I don't own gold because I think it might go from $1,950 an ounce to $2,100 an ounce. I don't care about that. That's absolutely irrelevant to me. For that kind of money, I'd rather stick in banking, a business I know. I buy gold because I'm afraid that because of quantitative easing and debt and deficits and negative real interest rates, that the price of gold measured in nominal terms, which is to say US dollar terms, goes to $6,000 or $7,000 or $8,000. And by the way, I'm not looking forward to that. The set of circumstances that would cause the gold price to go to $8,000 would be very hard on the rest of my lifestyle, which is really good. If you think about gold as insurance, you understand its true function. Do you want to collect on life insurance, Sean? If you collect on your auto insurance, there was a wreck. Housing insurance means that your house got burned down or somebody broke into it. That's the way I regard my gold.
Right.
My gold stocks are different. They're businesses. And the way they have been run for 50 years, they're pretty lousy businesses. They were run on the lessons that the industry learned in the 1970s. In other words, they are built to capitalize on the leverage of the gold price rather than to be efficient. It's interesting to note, Sean, and this is horrific. In the period 2000 to 2010, a wonderful run of the gold price where it went from $250 to $1,800 or something like that. The free cash flow per share of the Philadelphia Gold and Silver Index, the XAU, free cash flow per share fell. The price of the commodity went up 7-fold, and the financial performance of the industry deteriorated over 7 years because the industry was structured around the leverage of higher gold prices rather than around corporate efficiency. The industry is now tarred with that brush. The investment community assumes that these guys are at best morons or at worst thieves. But the reality has changed. The investors who own gold shares are demanding corporate performance. Specifically the managers that delivered that sterling performance have been allowed to pursue other employment opportunities, selling cars or whatever it is that they want to do. So the industry is in better shape, frankly, now than it was then. The industry has other challenges, but the other thing is that the industry is no longer priced for perfection. It was common to see gold mining companies priced at 1.8 to 2 times the net present value of their future cash flows at the then prevailing commodity prices. You're seeing them now priced at 0.8 or 0.9 times the net present value of the future cash flows at today's gold prices. And I think gold prices go up. When does this happen? I have no earthly idea. I really, really, really don't. But it is relatively simple for me to find 6 senior gold mining companies that I think are reasonably priced using objective measures and stupidly priced if, unfortunately, I'm right about the direction of the gold price. And I agree with you. The industry is hated. And I love that. It's weird, Sean, when people go to buy physical goods, cases of tuna fish, canned tuna fish in my earlier example, or a winter coat, they shop for sales. When people buy financial assets, they want them to be overpriced. They want to overpay. They want the psychological gratification of the price going up. This is truly insane. Mm-hmm. If your wife went to a shopping mall and she was looking for a winter coat and she saw a sign that said all goods 50% off, fine coats for half the price of 2 years ago, she'd be on it like white on rice,
Literally.
If she saw a different sign in the mall that said premium prices, no sales ever, our coats are now 40% more expensive than they were 2 years ago, she'd recoil in disgust. If more people shop for financial assets the way your wife shopped for coats, the world would be a better place.
Oh, I couldn't agree more. That's fantastic. So let's, and if we could just real quick, silver, do you feel the same way about that? Because that has just been incredibly frustrating, just watching both the metal and the silver miners as well.
I don't see silver as an insurance asset like I do gold. I see it as a speculative asset.
Right.
And in my experience, a precious metals market is led off by gold. It's led off by the fear buyer.
Right. Okay.
Once the momentum has been established, once the narrative has been common, silver moves further and it moves faster. But that happens in the middle of the market, and the market hasn't started yet.
Right.
This is probably a good time for speculators to focus on silver stocks because they have no competition. Warren Buffett famously said, buy straw hats in winter. Well, in terms of the silver equity, man, you are in the winter. People who were discouraged by the collapse of the mini boom in 2020, 2021, the Reddit boom in silver, regard silver, perhaps because they're poor spellers, as a 4-letter word. There is nothing I like as a speculator so much as an asset class that has disappointed the faithful. And silver describes it very well. My friend Doug Casey, who is an excellent historical chronicler of the silver markets, observed that the combined market capitalization of the viable silver companies, including the few viable juniors in the world, is so small that when the generalist money invades that space, the market caps can't contain the money that comes in. He colorfully describes the outcome as attempting to siphon Hoover Dam through a garden hose. I'll give you a few historical examples. In the great 1970 silver bull market, which I don't think will ever be repeated, the price of Coeur d'Alene mines advanced from 10 cents a share to $65 a share. Unfortunately, without me. Going forward, however, to the silver bull market of the early part of the decade of the 90s, we were part of constructing both Silver Standard and Pan American. Those stocks rose from 74 cents and 50 cents, respectively, to in excess of $40 within the 6 or 7 year time frame. That is what happens with a well-constructed but out of favor silver stock when they return to favor. That doesn't mean that with visions of those, sugar plums in your mind, that you put your whole net worth into speculative silver stocks. It means that you put 2.5 or 3% of your portfolio into them in hopes that they become 30 or 40% of your portfolio.
That's fantastic. Wonderful advice. Is there before we sign off? I mean, I would ask you like your greed trade, your fear trade, your contrarian trade. I think you gave them all to us already. Is there anything that you'd like to add? Any kind of nugget tidbit before we sign off?
I think two things. I think people need to continue to pay attention to conventional energy, including coal.
Right. Okay.
People hate coal. Except people who want electricity. The biggest year on record for coal demand was 2022. It was eclipsed in 2023 in October. Demand for coal is going up, the big thinkers notwithstanding. Even the big thinkers in Germany now are tearing down a solar plant to do pre-stripping for coal mine.
I was just going to say that. Yeah, that's amazing, isn't it?
And the other part of carbon, which is even bigger, is oil and gas. The big thinkers in the world tell you that the oil and gas industry is going to end. The peak oil demand is going to occur in 2032. How will 1,000 big thinkers fly their private jets to Davos to tell you to drive less if they don't have jet fuel? How is that going to happen? Sean, let me give you another statistic. I love statistics as a credit analyst. Humankind, the politically correct phrase for all of us, has now invested $5 trillion in 40 years in alternative energies. $5 trillion. And we've reduced the market share of fossil fuels from a high of 82% 40 years ago to a low of 81% today. $5 trillion has reduced the market share of fossil fuels by 1%. So for real investors, people who care about reality, not narrative. Look at the Exxons of the world. Look at the Chevrons of the world. If you want a better arbitrage than that, American natural gas, stranded American natural gas, Devon, Equitable. Or if you have more courage than that, Canadian oil and gas, where the prime minister of the country is a sworn enemy of the best business in his country. Look at companies like ARC, the best run oil company in Canada, Tourmaline, Peyto, Prairie Sky, Birchcliff. There are so many. Despite the fact that fossil fuels and fossil fuel equity prices have come up from the COVID-induced bottoms of 2021, 2022, they are still cheap. They're cheap because they're priced like the industry is going to end in 2032. I suspect peak oil demand occurs in 2065. So pay attention to energy. Finally, my final thought is a blatant commercial. If people like what I've had to say about natural resources investing, which is the only thing I know about, I invite them to continue the conversation. If you go to my website, ruleinvestmentmedia.com, and you list your natural resource stocks, by the way, please no crypto, no tech stocks, no pot stocks, your natural resource stocks, I'll personally, for free, no obligation, rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments might have value. And I want to repeat, if you are unhappy with your current banking relationships, which is to say, if you have an IQ north of 10 and a pulse, check out battlebank.com.
You Battle Bank. Battle Bank is your baby now, and what I was just thinking about regulators, like you're kind of like running into the gunfire there, aren't you?
Sean, if any of your listeners are thinking about a retirement, I would not recommend starting a bank. It's very, very, very hard work. but I've now been part of 7 banks. And being a credit analyst, it's a business that I understand. Part of the business is lending money, but most of the business is getting paid back. And I'm pretty good at that. The Battle Bank story starts really in 1998 when a group of people came together on my living room floor. And we founded a bank called Everbank, one of the first of the internet banks worldwide. And we worked hard for 14 years. You normally work 10 years to be an overnight success. But we worked 14 years. And we built a bank from 0 deposits to 28 billion deposits, from 0 customers to 275,000 customers. And we did it with innovative deposit products in particular. In 2014, we sold that bank to TIAA-CREF, having taken it public on the New York Stock Exchange. Everyone was happy. TIAA has 1.5 million members, serving mostly the teachers community in the United States. The consequence of that was that the innovative deposit products and the niche marketing products that Everbank had, servicing, among other communities, the Goldbug community, were of less interest to TIAA. And over time, they sort of abandoned them, which meant that the 275,000 customers to what had been our bank became orphans. And as more and more of them approached us about the fact that their bank, which had been our bank, had left them, the more intrigued we were about reactivating that community. So we've done it. We're starting Battle Bank. It's an organization now. I should tell you, you can't open an account with Battle Bank, but you can get on the waiting list to do it. The value proposition is simple. We're not going to have 15 US dollar savings products, most of which won't pay you any interest. We're going to have a high yield money market account that'll be in the top quartile of interest payers nationwide. If you want to write checks on it, God bless. Repeat, we're going to pay you interest on your checking account, unlike the criminals where you bank now. We aren't going to make you just save money in US dollars. If you want to save in federally insured deposits in euros, in yen, in Great British pounds, in Canadian dollars, Australian dollars, Hong Kong dollars, 22 different currencies, the choice is yours. Federally insured certificates of deposit in 22 currencies. Your IRA, your IRA at our bank will be your IRA. Your IRA can own an LLC. You can invest in private equity. You can invest in duplexes or triplexes or fourplexes. In most of the world, your IRA is a repository for somebody else's investment product. At Battle Bank, your IRA is your IRA, and we'll help you invest it the way you want to invest it. And another thing that your listeners will love, Sean, there are no banks in the United States that consider gold to be good collateral. This is one of the dumbest mistakes in humankind. If you own physical gold, physical silver, physical platinum, physical palladium, and you own it in segregated storage at recognized publicly traded vaults so that we can see the balance sheet and the income statement of your vault, we will loan you. You can use your precious metals holding to secure a credit facility. Let's say that you own $1 million worth of gold. You don't want to sell it, but you need $500,000 as a down payment on a second home or something like that. Done. Come to Battle Bank, it's done. So we're building a bank around a bunch of niche markets. Now, with regards to regulation, yes, I've gone from a regulated business to a regulated business. It's important to know that I am backing Battle Bank. I am not running Battle Bank. I am not the CEO. And I have to tell you too, Sean, that for all the things that are wrong with the People's Republic of the United States, what I have found to my surprise is that the low and mid-level employees at each of the Office of the Comptroller of the Currency, the Federal Reserve, and the FDIC are very smart, mostly kind, fairly well-motivated young people. I'm having some problems at the top of one of those agencies where they're much more political, but I'm absolutely delighted to find, particularly in the OCC, several people who, after we get our charter, we might try and steal.
Oh, great. Oh, I love that. Well, that's really great to hear. And it sounds like an amazing story. And congratulations on your, failed retirement. I'm happy to hear about that.
Well, I would urge any of your listeners who are unhappy with their current bank, which I suspect is all of them, to go to battlebank.com. 11,000 people have now joined the waiting list. And we would like to increase the size of that waiting list so that we can open with a bang.
That is fantastic. Rick Rule, thank you so much. Everybody, battlebank.com, ruleinvestmentmedia.com. I can't encourage you enough to take advantage of those offers if this man is giving them to you. Rick, thank you so much for joining us. That was absolutely wonderful.
John, thank you. And thank you for the wonderful reading I enjoy from the Rude Empire.
Thank you very much. Everybody, thank you for your time and take care. See you next time.